Hi, this is Michael Carlin, president of Henry+Horne Wealth Management in Scottsdale, Arizona, with episode 2 of the Manage the Funds podcast. Today we're talking about transitioning small business. I'm excited and delighted today to be joined by Phil McCollum. Phil is a partner at Henry+Horne, and he specializes in helping business owners transition their firms, their organizations, their institutions, sometimes to the next generation, sometimes to somebody else. Phil, thanks for joining.
Thanks for having me today. Happy to be here.
Well, today is a critical and important discussion that I find is not had often enough, and that we have so many small business owners as clients that haven't had this discussion, this thoughtful discussion about the most important asset that they own. We do a lot of talking about stocks, bonds, and cash. We talk a lot about residential real estate and buying a second home. We talk about all these different things in finance and financing, but we don't spend a lot of time or enough time talking about the business asset. What are we going to do with it? How do we make it work for us beyond just having an income? So Phil's going to help us break that down today. Again, critically important, and I'm excited. I want to start with a couple of facts, things that you should know. According to the Small Business Administration, do you know that small business represents 99.7% of all the businesses in the United States? Virtually all of them. And again, small businesses, but from 1995 to today, they created 64% of all new jobs. It's a vital part and a vital part of the fabric of the U.S. economy, and it's something that really needs to be digested and understood. Because you think about it, in that it's so difficult to start a new small business. They so often fail. In fact, about 2/3 of small businesses survive 2 years. Half of all new businesses survive 5 years, and a third only make it to year 10. So Phil, goodness, we've got this important asset to the U.S. economy, to people's families and lives. It's beyond just an income. Why don't we start at the very beginning, and that is, what do you need to know before you start to think about selling your business?
Well, that's a great amount of information and facts there, Michael, to understand how important small business is to the United States. And selling a business isn't just as simple as tomorrow you walk in the doors of your office and say, I'm going to sell my business. It takes several years of preparation. There's steps to follow. There's a lot of thought process, too, that you go through as an owner, because there's an emotional investment in this idea, this concept that you created over a number of years. So one of the first things you'll want to do is, okay, get your house in order. What does that mean? Well, one of the biggest things a buyer's going to look at is your financial statements and your financial information. You want to get those tax returns and financial statements in order. Many buyers like to see a financial statement that has a level of certification from an accounting firm. That can be compiled financial statements, reviewed financial statements, or audited financial statements. And those are very important because it provides some history of the company, the trends of the company, and then along with that, the tax returns should report or confirm the information that's reported in the financial statements. So a prospective buyer is going to ask for those from day one. If you have internal financials, it doesn't mean the deal's not going to happen, but you may be asked to do some more work on that.
Yeah, you got to think about it from a buyer's perspective, and we'll probably bring that up more than once, but a buyer of this asset is going to really want to make sure that the data that they're looking at and the type of organization they're buying, the profitability that they're buying is authentic, and an accounting firm can help get you that sense of security if you're a buyer. So in addition, we know you got to get confidentiality, non-solicitation agreements in place. So that we know. So that you got to have. So once you've gotten those things in place, some other things that you might want to do before you sell the business.
So you decided you're going to sell the business. You've got some of your financial information in order. Now you have to think about, okay, how long is this timeline going to take for me to sell this business? And what am I going to do afterwards? Do I want to be involved with the business as it goes on for a couple of years, 5 years, 3 years? And you see this a lot as well, the impact on the employees that remain with the company. This is where that emotional investment becomes really important. The business owners may have had employees for 20, 30 years, and now the impact on those employees is very important. How do you want to see that play out for the employees in that priority? And that's a non-financial factor, motivating factor, but it's very important. And then just the impact on your family and what you want to do after you sell the business. Those things really come into play. It's your personal goals.
And Phil, it seems to me that this part of the process, understanding the end, you want to do that as soon as possible. This isn't something that you want to wait to the end, because there are so many factors, internal and external, that you don't just all of a sudden in the end just decide real quickly, today I'm going to sell. I'm going to think about it 3 years from now or 4 years from now. This is something you start to plan with the end in mind sooner rather than later, I would think.
That's right. It's the planning up front to say, I'm ready to sell this. And then two, what do I do after I sell it? What do I want this to look like? What's my legacy? Whether that legacy is for your family or for the business itself. It takes a lot of thought and time, but it can be done if you start on this path early enough.
Yeah, it's critical. So one of the things that a lot of clients come to me, Phil, and say, which I don't think is quite right, but I want to hear you. You're the expert. They say to me, "Oh, well," they talk about my revenue. My revenue's up. My revenue's growing, and revenue did this, and revenue did that. And I said, "Well, revenue is important, but is revenue growth the most important financial factor that a buyer is looking at?"
Many cases it's not. It depends upon the buyer. If it's a strategic buyer, revenues may be important or likely are. But if it's someone that's looking to operate the business and they're not looking to expand into different markets, this is maybe a key employee that's going to take over. They're going to be interested in that profit. They're going to look at some of the expenses that have been incurred, and are these normalized expenses? Are these going to be expenses that incur in the future? So the profit becomes very important, and what they can do to that. Is it a profit margin that's very flexible? You can move things around from a depreciation standpoint or a cash flow standpoint, or is it very rigid and you know what you're going to get, and maybe there's not much room that you can do to improve that net profit? So yes, that's very important what that profit looks like.
Did you want to take a second to talk about strategic buyer versus the other type of acquiring candidate? So I know we're jumping a little bit towards the end, but I just think that you brought it up. I want to make sure we kind of hit that term pretty quick.
Sure. So a strategic buyer, we see plenty of those, say, among venture capitalist groups. We've seen a lot of that in healthcare industry the last few years, where they want to get into a new market or a new subclass of healthcare. So they're looking at the revenue of the firm because they figure they can add that to their top line, and then that improves their overall multiple, makes them more attractive to investors. So they're not as concerned about the profit because a lot of their overhead costs is going to be absorbed by their own accounting operation or administration office.
Got it. So a couple of notes that I wanted to throw in. We've had so many clients going through as you have two transitioning their business that we want to make sure that we kind of knock off really quick. Is that one of the things that I've seen is that clients end up, when they're going through the process of selling, they forget in some cases to run the business. They just get so caught up in the exit and get so excited about the future that they fail to keep their eye on the ball. So do make sure that you, as you're going through that beginning part of the process, do not take your eye off the ball. And one final point that I know you wanted to make, so why don't we just get into it, is if you're thinking about the end in mind, the things that you're going to want to do before selling the business, what can you do to increase the value of your business?
Well, this is where you come in to look at what industry you're in and what are the current, say, ratios, profit loss ratios or current asset ratios, different factors that are in that line of business, to say, you know what, we're below average in this area. What do we need to do to firm this up? Because if you can start on that process before you ever even go to market with a broker or a potential buyer, you're going to firm some things up internally already, and maybe your wages to the owner is too high, maybe your rent that you're paying for your building is too high, and you need to do some strategic items to get things in place, and that improvement to the bottom line can pay off tremendously on the sales price that you receive.
Yeah, we see that, if you own the building that your business is in, it can be an opportunity and a challenge depending upon how you're structured that deal. So we're gonna switch to our second topic, a little bit more about understanding the business asset, and what we want to do there is start to unpack some of the things that you have. what your organization looks like, how to start to put together all these pieces of the puzzle. So Phil, when you're again thinking about your business from a buyer's perspective, what are some of the things that a potential seller, a business owner, a key executive of that small business needs to be thinking about?
So when the owner starts the process of looking at what they're going to get out of this business, they need to get their team together. You can't do this in a vacuum. You need to get your CPA together with your attorneys, your financial advisors, and whether or not you have a broker or a investment banker involved, to understand, okay, here's what's out in the marketplace, here's what the buyers are looking for, here is what the overall sales price could look like, but even more importantly, what's this going to look like after you pay taxes? Right. I remember a few years ago.
Yeah, I was excited for you to bring up taxes. I was like, I'm ready. Here we go.
I know a few years ago I had a client that they had a number in mind as to what they wanted to get after tax. And we said, okay, well, we'll present that to the buyer. And we presented it to the buyer, and the buyer in about 10 minutes said, you're not going to get that. And that ended the meeting. So it was good because we got it out of the way right away. It helped reset their expectations to a more reasonable number. But then that can also lead to, how do you structure this thing differently for tax? Maybe they've traditionally been a C corporation. Maybe now it's time to convert to S corp and get some time as an S corp to potentially eliminate some taxes.
So what happens? How do you eliminate taxes going from C to an S? Is there a way to boil that down within a short period of time?
Sure. So with just briefly, C corps, you have the double tax because the C corps will pay tax, and then if they want to get the cash out or the income out to their investors, they got to issue a dividend. So there's the second level of tax, or second layer of tax. Conversion to S corp, after a period of 5 years, when you go from C to S, you have eliminated that double taxation because all the income is passing through to the owners. And then if you take cash out of the business as an S, more likely than that, you're going to be okay. So there's no second level of tax.
Right.
So that can be one way to get more efficient tax-wise.
And you got to do that for a couple of years.
Yeah, you should do it. It's 5 years. It used to be 10. They've made it 5 years now. So the 5 years can go pretty quick. And if you're starting to think of selling your business, you may need 5 years to get to that spot.
Start planning soon. Start planning quickly. Get that team together. So one of the things that always strikes me about businesses is that I don't know if you knew this statistically, but 82% of businesses, small businesses, fail because of cash flow problems. Which is crazy to think about, but that's the number one reason why small businesses fail. It isn't so much to talk about revenue and the money that comes in through the door, because a lot of it has to do with timing, and a lot of that has to do with, again, how you structure the financials of your organization. Make sure you're doing that part of the business right. So work with your CPA to get that done right. And as you're looking at cash flows, as you're looking at that most sensitive area of business, small business success, we get into, again, understanding the value of the business, and that is how do you and when do you start to think about a business valuation?
Well, once you get your house in order financially, let's say you got your compiled financial statements and your tax returns are all caught up and you're consistent there, you've looked at what your overall end game is, then you would want to look at someone coming in to take a look at what the value of the business is. You've an objective third party that has information and research available to them to come up with a range of value for your business. It doesn't mean that's the number you're going to get, but it gives you an indication of what it might be worth. And then that also can help you determine, well, you know what, here's what else I need to do to increase the value of this business. And I've worked with business owners that they don't want to know the value of their business because they're afraid it might be lower than they think. And we work with them to help them understand you need to know the number, because how do you know you're not getting lowballed when you get an offer? And that usually gets them to think about, I need a valuation.
We also see clients sometimes that will say or see these major, huge transactions in their business, in their marketplace, and think, well, I'll just go ahead and get the same thing for me or the same valuation. Maybe not. It depends upon a lot of different circumstances. So, but we rather than point to what you've seen or what you've read, a business valuation will help give you an independent third-party view of what your financials are and what that looks like industry-wide. And it just makes a lot of sense to wrap your head around what your asset looks like. So, did you want to comment on that?
Well, every deal is a different deal. Every buyer has a different motivation. Every seller has a different motivation. And so you're right. You just can't look at an industry multiple and say, that applies to me, because it's not.
It's very complicated.
Yes, it is.
So one of the things that you highlight is putting your real estate and maybe pulling that out prior to selling the business. What does that look like? Because we see that a lot. We see these dental offices, or we see big office parks that are owned by the organization or the entity, and they're paying themselves rent. And talk a little bit about why you would do it, when you would do it, and what that would look like.
Well, in many cases, real estate is going to be a source of income for the seller of the business. So the business may be in a location that's been there for 5-10 years. They've got a long-term lease. They want the buyer to take on that lease. So, and also the seller looks at that as a source of income, retirement income, and it could be a significant amount. So that's usually part of the deal. So you would want to look at ways of getting it out of an entity, say it's in a corp or an LLC. You want to be careful because you look at the tax ramifications of that. But look at that because that may be an asset you want to keep, or there may be other assets in the business that you want to keep as you move ahead. So, but real estate's one of the most common ones we see because of the value and the continuous income stream.
Right. And so would you see more often than not, Phil, that they would end up selling and separating the business and selling the building before the sale? Or do you think that they would often try to maintain the real estate through the sale? Do you see a little of everything? Is there one thing more common than another?
I'd say most of the things we'll see or transactions we deal with are going to be the owner keeps the real estate and hangs on for another 3 to 5 years, and then they can open up the lease term for negotiation. By then, the buyer has an idea of if this is the right location, what their expansion plans have been. So typically, we see the owner hold on to it through a few-year period after the transaction closes.
And do you know why I like that? I like that from a planning perspective because as the advisor on the other end of the transaction, when you're dealing with someone that's selling a business that all of a sudden losing income, having that building to provide some sort of income stabilization is really key and critical to help smooth out that whole process about, oh my gosh, I sold my business, I've lost my income, now what? We'll get more into what that looks like at the end of the day. But for me, from a planning perspective, I always like it when a business owner can maintain that real estate, enjoy that income as they ease into the next phase of their financial life.
The real estate can easily be their second most valuable asset that they have, and they might want to keep it in the family for years, look at gifting it. So yes, it definitely is something that we see owners try to hold on to for a few years.
One last note that I'd like to make before we get off this topic about understanding your asset, the organization asset, is that try to avoid the situation where any one client is worth more than 10% or is more than 10% of your business. Again, you want to try to maximize your organization's value, and too much dependence on any one client can end up being a net negative in the eyes of a potential buyer.
We have seen that in the past, and when you have a customer that is such a large portion of your revenue base and that customer is very successful, they may be swooped up, and now you don't have a connection with that client anymore. The purchaser is located in a different part of the country geographically. They want to use their own person. So you definitely want to try to have a broad customer base so that you can weather those situations, because they're going to happen. And just the reliance upon one customer can be traumatic and troubling, and it also could decrease your value because you were reliant upon one customer, especially if there's no long-term contract in place with that customer.
Right. One interesting thing I pulled off the Small Business Association's website is they broke down really nicely what an acquiring company is looking for, and they narrowed it down to their top 6 items. Number 1 was the right product or niche. They want a buyer's looking to get into the right trend, the right long-term type of revenue stream that's going to be growing over time. So that's the number 1 item. So if you own a small business, for a key executive small business, make sure you're in the right long-term niche again, you don't want to be competing with Amazon. You don't want to be in a shrinking market. You want to be in a growing market. Number 2, a company that has the right funding could become bigger. Normally, an acquiring company will come in and they will bolster the acquirer's finances and their balance sheet to give them more capital to do something to grow. And a potential buyer is looking at that as a net benefit. You could feel free to jump in on any of these things. We're at number 3, a clean balance sheet. one of the things that seems very obvious, Phil. You're not going to want to have something that's too complicated, too complex. It doesn't make a lot of sense to the buyer. I'm not surprised, or maybe in some cases I am surprised when I see that some cases stories sell companies, and a clean balance sheet is one of the things that kind of holds the fabric of that story together.
It eliminates a lot of questions. It makes any questions that come your way easier to handle and understand, and can get you through that due diligence process a lot quicker.
Right.
When you have a buyer looking at you and you've got a clean set of financials.
Number 4, clean operating history, steady business and clean track record, obvious, self-explanatory. Number 5, experience management. Again, it depends upon who's acquiring the company, but in most cases, from what I've seen, I wonder if you've seen the same, that the acquiring company wants to buy that expertise, wants to buy some of that operating prowess that has generated the profits and the revenues in that small business when they're making that acquisition.
That's where the key management team comes into play. We see that is very important, and that's where that emotional, personal connection of the owner is. You've got a really great management team that you've put together over years. There's value to those folks, and the buyer sees that, and you want them to see that, and then you hope that the buyer will keep those folks around for a couple more years and not just send the work back to another part of the country.
Right.
But the key management team is key. It helps you focus on the big picture, you as owner on the big items, and those key management folks can provide input and help to run the day-to-day affairs of the company.
Yes, and in the number 6 item that I picked out off the site, a history of enhancing shareholder value. So the way that I look at that is you don't want to have the type of financials that just show an amazing 2017. You didn't have a profitable 2015 or 16, but 17 was great, so now is when I'm going to be going ahead and marketing my business. You're going to want to be able to demonstrate a long track record of performance. This isn't the kind of thing that 1 or 2 years when you've got a track record of doing something else, or your track record is showing that profitability is slowing or revenues are slowing. That could be the kind of thing that can make a shareholder and prospective seller a little bit nervous when they're trying to transition their business.
We love seeing companies that have increasing sales, increasing bottom line, trajectory of heading upwards. With that, it shows the buyer that there's some value there, that there's nimbleness in the company because they're changing over time. And if they're able to increase the sales and the bottom line of the company as the market changes, that just provides more support and value to that potential buyer. Right. By seeing those kind of records.
Agreed. So, structure of the deal. Let's talk about this because, gosh, I mean, a lot of clients, they'll say, all right, well, I'm going to sell my business, but what does that look like? And most of them think going into it, I'm just going to get a check in cash up front and then I'm done. But that's not frequently how it works.
You're correct. Frequently, it doesn't happen that way, and also for tax efficiency reasons, you may not want that money all up front, especially if you sell it up on an installment note. You can defer that gain over a period of years. There may be certain assets that you have to pay higher tax rates on than just capital gains, so that's very important. The other part that we'll see sometimes is when a seller wants to be involved with the business going forward, do they want some of their shares that they're getting or their cash that they're getting actually be units in the new company, the buyer, so that they roll over their investment and defer the tax on that piece of it so that they have some say-so in a new company and a small investment piece. We see that too, and especially with partnerships. So that's something else. And that, once again, comes down to very personal decisions by the business owner as to what they want to do going forward.
Right. And so let's talk, you mentioned installment note. Can you want to unpack that a little bit? That would be great.
Sure. So let's say a business owner has agreed to sell his business for $10 million, and that payment isn't made in 1 year. It could be made over a 2-year period, 3-year period. I've seen them up to 5 years. So what that does is it shows, and a lot of times you'll see the seller of that business still be involved with the business because there's a little bit of, hey, we'll keep you on and we'll pay you off over 5 years, but we need your help to keep this thing going so that you get your money down the road. So we'll see that. That's very common. We'll also see as I mentioned, the key executives or the owner will have a W-2 or some sort of guaranteed payment for a few years, and it might drop over a couple of years too as they become less involved, really to help that transition of the business, especially if it's been around for 30, 35 years. One of the documents that's really important to get in the process is a letter of intent. And this can be a one-page letter, can be a four-page letter, but it really lays out the key terms of the deal and what the price is going to be, the structure, the timelines, what each party's timeline is to this transaction. Because one thing you don't want to have in these transactions is open-endedness. Because if you don't have any set time frames or deadlines, things can just linger and go on. And when that happens, things don't get done. Businesses don't get sold.
In that letter of intent, hopefully it spells things out clearly and effectively so that you can really get a sense for what that prospective buyer is offering.
Correct.
Laid out in a way that makes sense.
That's right. And you want to get your attorneys and your CPAs involved with that because there'll be some tax impact discussed in that letter of intent and also some legal wording and writing that's involved that you want your attorney to look at because so that you don't pin yourself into something that you don't understand.
Did you want to talk for a minute about whether or not you use an investment banker, using a broker? In my experience, we will help clients work with an investment banker. Usually, when it's a much bigger opportunity, a broker may be smaller. But how do you figure out which of the two, or if you use one of those at all, to help you in the sale of your business?
So, if it's a rather large business, and let's just say it's the potential deal on the table, you're thinking this business is worth $10 million or more, it's probably worth looking at having an investment banker involved. And you do want to get them involved early on because they're going to be the ones that are going to be selling your business. They're going to be out there marketing it. And if it ends up being the transaction that it's going to be less than $10 million, or you think it's once you get your business valuation in place that gives you an indication of value, a broker can work well, especially if you have a business that is going to be a local business, say it's in the Valley here, that doesn't have any plans to expand. You just want to keep it local. A broker can be very helpful because they're going to know the other business owners in the market. But larger deals, the investment bankers play a very, very valuable role in trying to market that company and quarterbacking things along the process.
In both cases, though, if you're working with either broker or investment banker, shouldn't a business owner be prepared to have somebody really crawling through the financials, and they're going to want to extract and squeeze all the information they can out of your business? I say that because I find that some business owners are surprised with how challenging that process is. They want it to be smooth and easy, and they don't want to have to spend a lot of time providing information, but it's time consuming.
It can be, and that's where having your management team, your folks involved with that are trusted and keep it confidential. And a lot of times they'll set up what we call data rooms, so that when you have one buyer come in, you have all the information ready for them. They can look at it online and say that buyer is not interested. The next time a buyer comes by, you already have the information ready to go, and it looks like you're organized and you're presenting it well. We see that. And the investment bankers, keep in mind, and the brokers, their overall end game is they want to sell the business. So there's a little bit of self-interest in there, and that's where getting some input from your CPA and your attorney is going to provide some objective insight as to, we'll also consider this.
Right, because the CPA or lawyer, they're not paid on the success of the sale. They're paid to advise. It's kind of like a real estate agent. They want to sell you a house or have you buy the house real quick. They want to make sure that happens quickly. Similar with an investment banker. Not to disparage either, but you do need to understand the motivations of the people that you're working with.
Right. They have a great skill set that is very valuable in a transaction, and so utilize them for what they can provide, but then also use the other folks on your team to bounce ideas off and understand what really is at play in your potential deal. We got to talk about deal types.
Because again, we mentioned briefly, it's not all cash up front. I mean, there's a whole bunch of different ways that things can get done. Would you be so kind as to unpack a few of them, the more tax knowledge you can provide? I know I love to hear it again, and I'm sure listeners do too.
So with the cash deal, of course, it's if you have all cash up front, you're going to have probably the highest amount of tax that you're going to pay, but you got all your cash. At times you will see what we call a stock transaction. Well, a buyer will receive part cash and part stock. And depending upon how that stock piece of the transaction is handled, they may have to pay tax on this receipt of stock, which is not the greatest thing because now you're getting an asset that you're having to write a check for taxes. Many times we see that stock really ends up being a interest in the buyer, the rollover interest that you're selling. So let's say you sold 80% of your business and 20% of it you're going to roll over into the new entity. That's the part that's deferred, and so you don't have to pay tax on that piece. So those are some common structure that we'll see. The long-term employment contract, we've seen them up to 5 years, which seems like a long time, but it goes fast. That's very common in medical practices. And there are other times the buyer or the seller, they just get out. They hand over the keys after the day of sale, and they're no longer involved. And I've seen that happen too.
But don't you see sometimes when you have an employment contract, you got a business owner that's never worked for anybody before, and sometimes they don't last long at the new company?
You do see that, and it's very stressful and hard on them. And they tried to, we've seen it where they just try to get a buyout and say, yeah, I can't do this anymore. So that's why when you will sometimes have a 5-year deal, it's the time that the previous owners involved drops each year.
Right.
First year you may get $100,000. Second year you're getting $60,000. So that's to reflect that less time is involved, and we're going to transition this. We don't need your help for the next We don't need your help full time for the next 5 years.
So in conclusion, it's a marathon, not a sprint?
It sure is. It's something that doesn't happen overnight, and you need to spend some time in the front end. But it's worth it it's worth it if you spend the time, the homework. And most people are so focused on the day-to-day operations that sitting back strategically isn't done enough. But when you do, and you work with your team advisors, it can really pay off on a much higher sales price than you would envision.
Right. And yes, and the final point that we want to go over quickly here is we want to make sure that you do spend the time as someone, a key executive and owner of a business, that you spend time figuring out how this transition would help you accomplish your financial objectives. And you need to have a post-sale plan put in place before you go through this process, because you need to start to make some baseline assessments and understandings to say, if I sell my business for this, either in cash or an installment sale, you do it over a long period of time, how does that look to me and my family from a financial perspective? And you need to create that long-term, cohesive cash flow, asset, liability, tax projection, so that you're understanding how all these components flow together. Too often, we have people that will think to themselves, one of my clients was looking to sell a bunch of franchises recently. And he was all excited and says, I think I'm going to get this number, millions of dollars. I'm going to get it, and that's enough for me to live and to retire. What I told him is, let's slow down, hang on a second, let's do the math. So we went through what he spends, we went through his total assets, investment picture, where they are now, his real estate picture, what he wants his real estate picture to look like when the businesses sell. And in the end, what we found out is this amount that he thinks he could sell for was about 70% of what he actually needed to retire. So what it did was, for us, it allowed a discussion to say, well, rather than sell it, maybe what we'll do is you'll do a reduced work schedule, you reduce your income, you bring on some more support staff so that you don't have the same schedule that you have now. But let's continue to have the business work for you financially for the long term, but create this understanding now. These are some of the things that we work on. We see, I'm sure you see the same kinds of things, and that understanding how this business asset unlocks and kind of folds into your personal financial picture.
Once you start the process of looking what the value of your business is from day one, that I'm going to sell this, when you get closer to the end, and not the day before you sell it, but the last couple of years, you should start meeting with your financial advisor to see what does it look like the day after the sale. What am I going to do? Am I going to be involved with charities? Do I have charitable desires? What is my cash flow need going to be for the years after that? Of course, things may change, but if you don't have a idea or a framework of what that might look like, then you get to day, as important as it is to prep for the sale, you better be ready for the day after the sale, because you're going to be, if you don't, you're going to be wondering, what do I do now? And then you're going to have some time to get back up on the planning track. It may take you a couple of years. So that's part of the process the last couple of years.
It's almost even too late. It's only, you got to do it early. So again, in conclusion, go early. We understand that your big challenges of running a small business. We understand that you've got economic uncertainty and we got health insurance challenges and you're worried about consumer spending. We're still worried about all the regulatory burdens, even though with the Trump administration, they've been doing a lot to reduce them. We get all of that. But what Phil and I have worked hard to try to do today, Phil, thank you for doing the heavy lifting.
You're welcome.
Appreciate it. Is that you start planning now. Plan early. Understand the asset that you have. This is a long-term process. This isn't something that you're going to race in and race out of. This is a significant opportunity that you've beat the odds. We've talked about most small businesses don't make it. You've made it. This is a chance for you, the key executives, their whole organization to benefit long-term. So start planning now.
And not only is it a long-term process, it's a process that evolves. So if it takes you 5 years, you want to sell your business in 5 years, a couple years from now, your goals may change, the economy may change, but you're already 2 years into the process. So it's not like you have to recreate the wheel. It's just modifying the steps along the way. And that will help save a lot of time during those steps as you move along. And it's important for you to determine what your personal goals are, your family goals, and what legacy you want to leave in the community and to the employees that you've looked over for so many years.
That's right. Incredible. Phil, you did it again. This concludes the second episode of our Manage the Funds podcast. We thank you for listening. Stay tuned. We will be in touch with our third installment of the podcast coming soon. Take care. Have a great day.